Most people wait until they see a deal, then they go get a policy. They miss the deal, they get their policy set up, and then they don't have an opportunity to deploy into. Here's the core insight most people never get. They think they have to sell their assets to build their wealth. And every time you sell, you trigger a taxable event, capital gains, income taxes, things of that nature. Now, unfortunately, VULs and IULs are what advisors love to sell for infinite banking because they get 50 to 130% commissions the year you fund that policy. If you put $10,000 in, they're making $5,000 all the way to $11,000, $12,000. Meanwhile, you make 4 to 6% a year. That sounds like a scam to me. Banks make money off your money every single day. You deposit it, they lend it out at 8, 10, 20% and pay you back 0.5%. What if you cut them out entirely? In this video, I'm going to show you the exact system I use to become my own bank and then deploy that capital into real deals without ever asking anybody for a loan. I've been doing this for years. I've used infinite banking to fund oil wells, real estate deals, and other private placement opportunities without going through a bank, without credit checks, and without triggering a taxable event every time I move capital. This isn't theory. This is what I do with my own money. And it's not the type of strategy your financial advisors are going to teach you. Now, before you say life insurance is a scam, I will say this. Most of it, I agree, absolutely is. And I said the same thing until I ran into someone who showed me how to do this structured correctly. And there's only about 100 professionals in the entire United States that actually offer what I'm going to be going over today. So stay with me until the end. With interest rates elevated and banks tightening lending standards, the people who have their own source of capital are going to have an enormous advantage in the next few years. And that window is right now. I'm going to walk you through why the wealthy never sell assets to access cash and how a properly structured whole life policy becomes your personal banking system, and exactly how I've used these policies to invest in private placement oil and real estate that yields 2 to 3x returns every few years. And it all starts with the first principle, which is why the wealthy never sell their assets. Here's the core insight most people never get. They think they have to sell their assets to build their wealth. And every time you sell, you trigger a taxable event, capital gains, income taxes, things of that nature. You lose the future compounding, and the wealthy figured this out a long time ago. They don't sell. They borrow against what they own and they go buy more of it. A billionaire with 10 billion in assets doesn't sell shares to fund a new investment. He borrows against them. They pledge those assets as collateral and take out a loan. No sale, no taxable event. They keep the asset and it keeps growing. This is exactly how major banks operate. A bank doesn't sell its bonds to make a loan. It uses those bonds as collateral to access capital and then lends that capital out at a profit. The bank's assets keep compounding while the bank profits from lending against them. That is the system. The question is, why aren't you doing this with your own assets? If you want to do this yourself, start with thinking about every asset you own as a collateral value, not just market value, gold, real estate, cash value, and a whole life policy. These are all things you can borrow against without selling. The goal is never to be forced to sell a good asset because you need the liquidity. The goal is to leverage an asset that appreciates so that you can use that leverage to build wealth by investing in other assets. So now you understand why the wealthy borrow instead of sell. If you really want to do this yourself without billions in assets, you need to understand how a properly structured whole life policy gives you access to the same mechanism. Which brings us to principle number 2, how infinite banking actually works. So here's your infinite banking 101, and I'm going to debunk what a lot of financial advisors do. First of all, they say buy term insurance. Term is literally like renting insurance. There's no cash value. Then you have what's called IULs, Index Universal Life Policies. Those tend to have rising insurance costs throughout the ownership of that policy. They usually only grow at 4 to 6% internal rates of return, which isn't very good. What I do tends to grow in that 6 to 12% range. Then you've got what's called VUL, Variable Universal Life. You choose the investment, therefore the risk is put on you, and when markets underperform, the insurance company says, hey, sorry, I told you so, but you actually chose the investment. We're not on the hook. You are. Sorry that you lost. Then you have whole life, but most people that buy whole life buy retail whole life, and a very few small percentage do what's called institutional grade, high early cash value, dividend paying whole life insurance. I'm talking about carriers that are older than Bank of America, Wells Fargo, or Chase. Ones like Mass Mutual, Northwestern Mutual, Guardian, New York Life, or Penn Mutual. Now, one of those is the holy grail above all and has never been beaten, and I'll tell you a little bit more about that. When you have a properly structured HECV, high early cash value policy, I'm not talking about your financial advisor and what they sell you. I'm talking about what the banks buy in the same exact yield curve that banks get access to whole life policies. There's what's called bank-owned life insurance, or BOLI, okay? There is a structure that exists for everyday citizens like you and me to get access to those bank grade policies as an individual investor. That is what I use. And you get two things. Now, unfortunately, VULs and IULs are what advisors love to sell for infinite banking because they get 50 to 130% commissions the year you fund that policy. If you put $10,000 in, they're making $5,000 all the way to $11,000, $12,000. Meanwhile, you make 4 to 6% a year. That sounds like a scam to me. On the other side, you have the HECV. Commissions get trimmed out and it prioritizes cash value growth. You get two things. A guaranteed return, which in today's interest rate environments is 2 to 4%, and a non-guaranteed dividend. The dividend of the company I use has never been less than 6% since the end of the Vietnam War. It's 6.6% for 2026. That dividend cannot legally be taxed. So I've got a guaranteed return and a non-guaranteed dividend. The next area where advisors go wrong is they tell you can't get both. But the truth is you can get both. You can get the guaranteed return and you can get the non-guaranteed dividend. I put these two together and I allow that growth to compound the cash value of my policy. So it starts with the right policy design and policy structure and not working with a financial advisor idiot, working with one of the few that actually understands how wealth is built. Once you have that, you get a third-party line of credit against that policy. Why would you get a third-party line of credit? Well, because the rates tend to be more competitive. In today's interest rate environments, whole life policies that are properly structured can grow at 6 to 12%, and your borrow rate is as low as 3.75%. So you have interest compounding the cash value, growing more and more every single year, growing at 6 to 12% over here, while you're borrowing at less than that. That is already making money. Then when you borrow and you go deploy that into assets that can do 2 to 3x in 5 to 7 year periods, which I'll talk about in a little bit here, this is growing without you getting rid of this asset. This is building you cash flow over here, and you can use all of that to increase the cash value of your policy. Do what's called overfunding that policy. Increase the line of credit, go repeat the process, but with a larger amount of capital to deploy, and you keep repeating that cycle. That is why it's called infinite banking, getting two returns simultaneously with the same dollars without ever having to liquidate your assets, while also getting all the tax advantages that I'll talk about in just a second here. Now you understand how the banking system works. Here's exactly how I've deployed third-party lines of credit against my policy into real deals and what that looks like in actual practice. Which brings us to our fourth principle, deploying third-party lines of credit against your whole life policy into real deals. The whole point of building this system isn't to have a fancy insurance policy. It's to have a source of on-demand capital you could deploy into real investments. For me, that means direct working interest in oil and energy wells and passive real estate investing. When a new oil deal comes to me and I like it, I take that third-party line of credit and I deploy into an asset that I know is going to pay me cash flow, so I can then use that cash flow to pay off the interest on that line of credit, pocket the rest, and then repeat the process. I funded oil well deals this way more than once. Same with real estate. The deal produces cash flow from the production. That cash flow services the debt on that line of credit. My policy never stops growing. And when that well is producing, I'm also getting a write-off in the year I invest through something called intangible drilling costs. I'm getting tangible drilling costs, and 15% of that cash flow that I earn from that oil well is tax-free. When I exit that fund, I pay back the line of credit, and by that time, my policy is increased in cash value. So I go back, I increase that line of credit, and I repeat the process with even more capital. Now, the bank makes money using your money. The question is, when do you start doing the same? If you want to do this yourself, start the policy now, before you have the deals lined up. Grow it, let it accumulate. The cash value takes a little bit of time to build. Most people wait until they see a deal, then they go get a policy. They miss the deal, they get their policy set up, and then they don't have an opportunity to deploy into. Build the banking system first. When the deals come, when they do, you'll be ready. So now you have the full system. Buy hard assets, build your policy, borrow against it, deploy into deals, repay, repeat. Here's exactly how to get started. Now, if you want to learn exactly how I do this step by step, the deals I'm in, see the statistics, and what the criteria is for me, I'm actually going to go over this on a free live webinar that I'm teaching. The link is in the description. You can register for it. On those webinars, I usually show you how you can win some free silver as well. I sent out about 80 ounces last month alone, and I do this every single month. So click the link and register for that webinar and make sure to attend. Okay, this is the exact process I use to multiply my wealth by 2 to 3x every few years on repeat. You're gonna see how I get into these policies. You're gonna see how I leverage it. And then you're gonna see what the specific criteria is for the deals I'm getting into, because they have to meet certain metrics when it comes to oil, and they have to meet certain metrics when it comes to real estate. And I'm doing both passively. I don't actively manage oil deals. I don't actively manage real estate. I just get checks, and they're in two different tax worlds. And so we're gonna cover both of those on this webinar. Click the link in the description and I'll see you on that webinar. Guys, if you love this video, smash that like button. Any questions, drop them in the comments. I try to reply to all of my comments, and make sure to tap that notification bell and subscribe so you stay updated on all of my videos. Here, all I'm teaching is how to build wealth like a capitalist off of what I personally do, not hypothetical stuff that your advisor wants to sell you, not selling you an insurance policy or an annuity, even though I don't do it myself, but actually providing you real world practical expertise based on what I do at a professional level, okay? So appreciate you guys watching the video, and I'll see you in the next one.